We're going to take a moment, guys, and talk about equity partners in a real estate transaction, maybe a little bit about novations as well. So if you find this video helpful, don't forget to like us. Subscribe to our YouTube channel. If you have any comments, take a minute and comment below as well. So often as investors, we need to bring in various partners. Those partners could be nothing more than a lender, or they could wind up being an equity partner in the transaction. And equity partners can earn that equity through several scenarios. They can come in as a private lender, where they want more than just an interest rate. They're looking for maybe a piece of the action or a higher return. And the way to protect themselves, of course, is to become an owner in the entity that owns the property. So they're able to do that properly and legally without violating any usury statutes that might exist in the state we are located. They may come in providing expertise to the transaction for acquisition, disposition, maybe the repairs in some scenario. Every situation is different when we talk to various partners out there and to what their roles will be. And so the question becomes, how do you put a deal together with all these people? Someone has to bring the property to the table to start off with, and maybe you're buying that property subject to the existing debt. Got it. And so, of course, you're going to buy that property into a corporate entity. Maybe you're going to buy that property using a private lender and using their funds for the acquisition capital at a stated interest rate, but they want more on top of that. And so in either of those scenarios, I like to make these equity partners, of course, a member or an owner of the limited liability company or corporation that's handling the closing, that's going to own the property. And they can get different percentages based on what they're doing. If one party is putting up all the money, carrying the interest load, whereas the other party is bringing the property to the table, maybe running all the construction crews, doing the work and things of that nature, maybe it's a 50-50 partnership. Maybe it's something different as well if it's a subject to deal. Maybe it's a 70-30, who knows what it might be. But so often these equity partners come in putting up equity one way or the other along the way. And all of these scenarios happen in real life, and I'm sure there's other variations that may occur. The key is making sure everybody is protected in the transaction and there's a good understanding of who is doing what. And this is not just a handshake, guys. You want to memorialize it in writing always. That's how you protect people in these deals. It's how you create goodwill between the equity partners, and you don't get into business spats that you want to try and avoid. So if a private lender is going to put the money up to buy the property, obviously they should have a first lien on that property to the entity that's buying it. And they should also be an owner of that entity if the negotiation was to make them an equity partner of some format. Likewise, if the other party is going to do all the repairs and bring the contractors to the table or things of that nature, and maybe they're a contracting partner who can bring the construction cost in at cost, saving possibly tens of thousands of dollars on a transaction. They deserve their equity position in that as well. But once you have come into the transaction, if there's any liens being created, whether it's a first lien mortgage, as we talked earlier, or maybe a second lien to a possible subject to transaction, or even a banking loan along the way, make sure there's a lien position out there that protects the money first and foremost. Then, if someone's doing the work on the property, make sure they're getting paid properly, and that is being set up. Maybe someone's going to agree to do the repairs out of pocket. And in that instance even, that contractor should create a lien on the property. So the contractor has an ownership interest in the property along with the first investor. The contractor files a lien on the property for the repairs being done. And then that's how the money they're putting into the property is protected. And then the parties make an agreement how to dispose of these liens when the property is sold. So if the property is slated to be sold on a retail basis, let's say, after paying all the closing costs of the sale, whatever those might be, there are dollars left over. Well, obviously the first lien mortgage gets paid first. If there's a second lien mortgage, it gets paid next. Maybe if there's a contractor who came in and they did all the work out of pocket without putting any money in the deal for the repairs themselves, they get paid next along the way. What's left over is the true profit in the transaction that can then be divided up however the parties have agreed to do so. Now, when you do this, structure those agreements in a way through basic corporate minutes and lay out who has what responsibility, who's making the monthly mortgage payment, or how are you dividing that up, who's in charge of repairs, both the actual construction, the design, things of that nature, and how do you meld that together? How will the final disposition be handled? Will someone list the property at cost? Will you hire a third-party realtor, maybe at 4%, 5%, 6%, whatever that might be? Will you use a discount broker for the listing? Then discuss things such as, if the property isn't moving, how are you going to reduce that mortgage, the asking price over time? Do you reduce it every 2 weeks, every 3 weeks, every 4 weeks? About how much? How do you make those decisions? Think through the transaction and think out long term and how you're going to look at this overall. And then stop and go, what if? What if something like this doesn't happen? What if the market changes? You can't sell the property. What is the next exit strategy? Do you rent it, sell or finance it? Do you convert maybe these short-term interest-only loans to longer-term loans based upon how you can sell the property or lease it out? Have some basic organization and think past the end of your nose, as I often say, so that you're able to anticipate the worst things that could happen out there. Now, you do the same thing, guys, with something like this in a novation agreement, where really the homeowner becomes your equity partner in the deal. It's the same thing as how I think you can best protect yourself instead of just doing a contract for sale only. If there are going to be monthly payments involved, if there's going to be a cash infusion to maybe bring a loan current or the repairs involved, you want to think through it in the same like-kind manner as we just discussed, because this is the main way that you're going to protect all the parties. You're going to maintain friendships, relationships, and you're going to create a willingness for all these parties to do the next deal and the next deal and the next deal. And that is about what our business is all about, is doing volume, not just doing one transaction. Guys, life is too short to mess up out there and to get into squabbles over little things. Do your best to lay these out up front, take care of issues. And I think if you do that, you do the best you can at these kind of items, you're going to eliminate 98% plus of all the issues you're going to run into on your equity partnership novation type transaction along the way. So guys, I hope you found this helpful. If you like it, take a minute and like it. Don't forget to subscribe to our YouTube channel. And once again, if you got any comments, click it below and give us your comments. And from there, if you want more information about real estate investing, especially in creative real estate investing, take a moment and visit us over at theownerfinancenetwork.com. And we'll see you guys next time.